Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 1st of August. It's been a pretty good week in the markets and another example of when bad news can be good news. The Federal Reserve hiked interest rates by 0.75% as expected, and also we had a US GDP number which came in below expectations. Now, despite these apparently negative pieces of news, there were some Federal Reserve comments which suggested that A, they were aware that aggressive interest rate hiking could push the country into recession, and B, that they didn't want to over tighten on that basis, even though inflation remains their core target. So we're now left in a situation where the US has seen 2 quarters of negative growth. In most other countries that would be a technical recession, but it's measured slightly differently in the States, including a number of other factors which are taken into account, such as employment, for example, and the US labour market remains extremely healthy. So we've also had some very strong earnings from the likes of a number of the FANG stocks, Amazon, Apple and Microsoft, and generally speaking this has underpinned gains for the week, although markets have got a fair way to go. In the year to date, the Dow Jones is now down by 10.5%, S&P 500 down 14.6%, Nasdaq down 22%, and the FTSE 100 has just about nudged into positive territory for the year again, up 0.1%. Earnings season continues apace next week on both sides of the pond. In the UK, there are 3 FTSE 100 companies to look out for in particular. Rounding off the banking reporting season, we're going to have half-year numbers from HSBC. It's actually had a pretty good run. The shares are up 29% over the last year, although on a 3-year view, they remain down 22%. So again, we need to be looking out for any credit impairment provisions, which with the exception of NatWest, have been a feature of the season so far. Obviously, HSBC's exposure to Asia and the Chinese problems we've had there. There had previously been some weakness in its wealth and private banking unit, and also, of course, the key metrics we need to look out for, such as its capital cushion, net interest income, net interest margin, etc. Also, half-year numbers due from BP. Perhaps unsurprisingly, shares up 33% over the last year. The oil price itself is up 40% in the year to date. We also had some fairly bumper numbers from Shell this week, so you can expect perhaps some further news on not only an increase to the dividend, but a potential share buyback program as well, and whether, a la Shell, BP has been able to pay down some net debt given the additional cash that's coming in the doors. Finally, there's a second quarter trading statement from Next. Shares have suffered a bit compared to the previous 2 here. They're down 14% in the over the last year. Look out for full price sales, how online sales are comparing with physical store sales. Shareholder returns. It's currently anticipated Next does have around £100 million of surplus cash, may find its way back to shareholders. But of course, offset against that, you've got input costs and general inflationary worries surrounding the retail sector. So that could be an interesting update. Thank you for watching. Have a great week.